Well, welcome. Thank you very much. My name is Arps, and what we're going to talk about right now is teaching an old dog new tricks. And what I mean by that is we've taken an old method that's been around for a long time and improved it considerably to where you can, we call it trading zone probabilities. And the trading zones are what many of you know as the floor trader pivots. And it has kind of an interesting history, and we're going to talk about that briefly, and then also how we are now using it. Okay, so what are trading zone probabilities? Well, basically it's a trading method based on statistical projections from historical market data to determine where prices are likely to trade during the day, where the market should run, and where the market should stop and reverse. Now, the point of all this is to find daily trading opportunities where the support and resistance probabilities are significantly higher than 50%. Zone probabilities will help us find a high probability target for a trade and the probability that a given stop will be hit. Now, here's what we're talking about. This is a modification of the floor traders pivots that you're all familiar with. There's S2, S1, pivot, R1, and R2. And what we've done is name each of these areas as a different zone. So from S2 down is zone 1. From S1 to S2 is zone 2. From the pivot to S1 is zone 3. From R1 to the pivot is zone 4. From R2 to R1 is zone 5, and anything above R2 is zone 6. And you can see that these lines change with every day. The vertical lines are the day breaks. The other thing that we see is these numbers here. The first number is the actual price, and the second number is the key thing that we're talking about today, and that is the percent chance that the price will reach this particular zone. So for example, up here in R2, which everything above R2 is zone 6, it says that the zone boundary is 972.53, and there's only a 17% chance that it will reach that zone. On zone 5 here, above R1, between R1 and R2, there's a 45% chance that it will reach that zone. And zone 4, there's a 100% chance that it will reach that, and that's because it was reached on the open of the day, so it was immediately 100%, and so forth on down the list. We'll get back to how this all works in a minute, but I just wanted to give you an idea of what the end result is here, which is to give you some odds as to where the price is likely to go today. Now, how do I know that? Well, I got to take you back to a book by Toby Crabel called Day Trading with Short-Term Price Patterns and Open Range Breakouts. He wrote this book back in 1990, approximately. Sold it for about 99 bucks. Interestingly enough, this book is so popular that I saw it recently go on eBay for $1,600. So if any of you have a copy of this book by Toby Crabel, keep it. Anyway, Toby Crabel talks about trading the opening range, and he talks about the relationship between the open of today and the close of yesterday. And as he says, there's a supply-demand battle taking place on the open, and that the direction of the open of the day is much more fruitful in determining a pattern for the day than the previous day's closing price, and that actually the relationship between the day's open and yesterday's close is very predictive of what's likely to happen today. So we talk about the floor traders pivots. You just saw these, and this is what they look like. You know, where the floor traders pivots came from originally. Well, back in the old days where the traders didn't have computers, they didn't have a lot of stuff except just a sheet of paper and a pencil, they needed to know where the price was with respect to, to put it in perspective as to where we were compared to yesterday's range and so forth. And so some clever trader came up with a calculation for pivot points. And here's you're pretty well all familiar with the calculation of the pivot points. Basically, the pivot is yesterday's high plus low plus close over 3. So that's the average price for yesterday's action. And then from there, they calculated an R1, a resistance 1, which is twice the pivot minus the low, a support 1, which is twice the pivot minus the high, and then one lower than that, which is the pivot plus the rate plus R1 minus S1, and the support, which is the pivot minus resistance 1 minus support 1. So this was at that time, back in the 70s and 80s, so-called secret formula. Only the traders on the floor knew about this, or tried to keep it away from everybody else. And so they would not only use that to get an idea as to where the prices were with respect to today's action, but also where it is with respect to some levels that they would use as support resistance levels. Everybody on the floor knew where they were, and when they got close to those levels, the traders would respond accordingly. Sooner or later, those so-called secrets came out, and now everybody pretty well knows those formulas, and they're referred to as the floor trader pivots. But what we've done is to use those floor trader pivot numbers as a way to put into perspective the relationship between yesterday's close and today's open. And then what we've done through a great deal of research over about 20 years worth of data is to look at every day's intraday behavior, look at where the price opened compared to where the price closed, where yesterday's price closed. And in order to keep it and to put it in the proper perspective, we arbitrarily use these floor trader pivot numbers to give us a comparison. And when you look at this chart, you can see that every day those numbers changed, and they changed as a function of whatever happened during that day, which is then going to affect the next day. So the zone probabilities method that we use to come up with these percentages as to where the price is likely to go today. First, you calculate today's floor pivot numbers based on yesterday's high, low, and close. Second, we define the trading zones based on the floor pivot levels, and then we define these different zones. And you can see zone 4 is the area between the pivot and R1, zone 5 is the area between the pivot and R2, and zone 6 is is above R2. And so here you can see again this same picture and see how we calculate these different zones. Okay, now that we've got these zones, and we went back and researched over 20 years of data, of intraday data, and what we basically were looking at is if the price opened in the zone, let's say 3, and it closed in zone, let me say it differently, I'm sorry, let's start with the close. If the price closed, like on this bar, it closed in zone 6, and then the next day it opened in zone 1, 2, 3, 4, that's a 6-4 combination. And we wrote down then, or the computer recorded, where did the price go during the day? What was the highest it went to? What's the lowest it went to? What zone did it enter? What zone did it not enter? And when we added all that information up, grounded through the computer, we came up with percentage odds as to, over the last 20 years, if you opened in zone 6, let's say, and, excuse me, if you closed in zone 6 and you opened the next day in zone 4, there was such and such a chance that the price would enter some of these other zones. So based on which of yesterday's zones yesterday's price closed and which of today's zones today's price action opened, we display the probabilities of the price reaching each of today's zones. And we go back to the number that I showed you a minute ago. So when we had this open to close combination, these were the different probabilities based on 20 years worth of data that the price would actually reach those zones. Now this could be very useful when we're making a trading decision, so that if I'm in this zone and I'm wondering what, and I'm over here at the open of the day, I'm wondering which way the market is going to go and whether it's going, how far it's going to reach, I can see that I have only a 45% chance that it will get up into this zone. I'll have a 58% chance that it's going to get down into this zone, and only a 21% chance that it's going to get down into this zone, and only a 4% chance it's going to get down into this zone. So I have a pretty good idea of the probabilities for over which this price for today is likely to go. And you can see that, okay, on this particular day, basically it stayed within this one zone. They stayed within this one zone most of the time, but it did peak through this 58% right here, and it did actually at the end of the day peak up through this 46%, but it never got up to the 17% there or the 21% there. When we look at the next day, okay, it always, when it opens, it's always 100% zone, because that's, you know, it's a 100% chance it's going to open and it's going to be in that zone. It never made it up to the 56% or the 22%, but it just ran right down into this 65% and busted down into the 28 before coming back up into the 100. So that gives you an idea of what we're looking at when we talk about the zone probabilities. Now let me look at show you some charts, some real-time charts, to give you an idea what it looks like in real time. Let's see if I can drag this baby over here. Come on. There you go. Okay. This is a 20,000 share chart of the S&P. And here are the day breaks, if you can see them. So let's see if we can get over to today. There we go. This is what I want to see. Okay. This is today, this is yesterday, this is the day before, this is the day before that. So this is looking at 1 week's worth of data. Now I've also put some other interesting tools on this chart that we'll talk about later, and I'll show you why I have those particular tools, because what we want to know what we want is something to help us decide when the market trends are about to change. I particularly like 20,000 share bars for the S&P because it gives me some smooth trends. And of course today was a very interesting day, as several of the previous speakers have talked about, and I'll be talking about that too. Pardon me. But just very quickly, in addition to the zones, we have a tool that we call the Arps, just a second. Arps Trend Locator. And that's this tool that paints the bars green when the trend is up, red when the bar is down, and white when it's going sideways. This is one of the tools that we use in our trading every day to help us determine when we should be long, when we should be short. The second tool that I have that I'm very proud of is the Arps trender. And here's the Arps trender that follows the price just far enough away so it doesn't get stopped out. Tells you what the trend is. You can see it identifies whenever price is in a trend. It flips very quickly, shows you the downtrend. So this tool in itself can help us very much in trading and making our trading decisions. Then we have two other tools here. This is the Arps directional bias, and this is a tool that looks at the trendiness of the markets and the direction, of course. When it's green and flat-topped, it means that it's in a very good trend, very strong trend. When it's gray, it's in a sideways trend. It's not moving. When it's red, it's in a downward trend. So this is yet another tool that we use to confirm the direction of the trend that we're in. Finally, I have a tool down here which is called the Arps Fear Greed Index, Radar 1. And what it's telling me is what's the interaction between volume and price so that I can get an idea of whether the bulls are in control or the bears are in control. And usually when the trends are beginning to change, this tool will get shorter as the bears start losing control, like right here, or in this case, where the bulls are losing control, or in this case, where the bears are losing control. You can see that this tool reached a low right here, which was before, which anticipated the turn. So at this point in time, the bears were beginning to cover their shorts, and the bulls were beginning to buy. And so we see a nice divergence between these two valleys here and those two valleys there. So it's a good indicator that gives me an idea as to when the bulls or the bears are in control. Finally, we can look at the percentages that we were talking about originally, and we see how we might want to trade it. Let's do this. Well, I was trying to scroll it back. It's not wanting to scroll right now. So pretend that you can't see this on the right. And when the market opens here, we look over and we say, okay, there's a 65% chance that the market will get into zone 5, only a 29% chance it's going to get into zone 6. There's a 67% chance that it'll get into zone 3. And if we look lower, just a second here, 33% going into zone 2 and 13% going into zone 1. So as I look at this at the beginning of the day, I'm seeing that the area that the market is likely to be in is below this 29% zone and above this 33% zone, and probably mostly trading in this 63-67% area. And indeed the market did, and it basically slowed down in the middle of the day between the two zone levels, and then it took a little burst of speed and broke up above the 29% at the very end of the day. And at the very beginning of the day, it had fulfilled its 67%, so that was already taken care of. If we look at the next day, we see that we opened in zone 4, 100%. And when we open in zone 4, we see these other numbers here. Okay, there's a 65% chance that it's going to get down here. So when we open here and we see the market start to go down, we can use this as a target and say, all right, it's likely that the market will go down to or into that 65% zone, and it probably is much less likely to go into a 28% or an 8% zone. So once the market goes down and it penetrates the 65% zone, we can start thinking about or start looking for a low, start looking for a turn to head back up and probably go up into this 56% zone, but probably not up into this 22% zone unless there's a really big burst that comes in there. So in this way, together with these other tools that give us an indication of when to buy and when to sell, we can get a very good idea as to how far the market, or within what range the market is likely to trade today. If we look at this day, which is Monday, Tuesday, and we see that, again, we have a 63% chance that this market is going to go up into zone 6. We're down here with the market when the market opens, so I would not be hesitant to take a long somewhere here with the objective of at least reaching this 63% zone. It just tagged it here, then came down, went right through the 67% zone, which is the other one, and stopped right on the 33% zone, and then went back up to our 63% once more, but it did not go to the 29% zone. So basically, when you're trading and you're trying to see what is likely to happen today, these zone percentages give you an idea as to what the odds are that the price will go to a particular part of the chart today. Over here, we're looking at what happened today, and some of the other authors have talked about what a wild day it was today. And the question is, could we have made money today looking at this chart? Well, okay, if we go back to the open, it opened down here, and we look and we see, okay, there's a 67% chance that it's going to get down to this zone, and a 63% chance it's going to get up to this zone. Well, first thing right out of the bat, the market goes down just far enough to penetrate that 67%. But it didn't stay there but a few minutes and then turn around and headed back up again. And with these green bars and with the Arps trender showing that the trend is up, it looks like to us that at least for the first half of the day, we should see an upward move heading at least to this 63% chance zone. And in fact, the price did just rocket up to 63% and kept right on going and broke into the 29% zone, which is certainly pretty strong. But then when we saw the price break the trender here, when we saw the trend identifier going red and the trender going red, we could see that probably the next move was down. We can also look at down here and see that these indicators were also telling us that the market had exhausted itself and was ready to make a pullback, which it did. It ran all the way back down to this 100% zone. Gave another attempt at going up to the 29% zone. This time it failed. And so as soon as we see some red bars here and we see the Arps trender moving down, we better get on board on the short side. It went down and checked out the 67% zone one more time, and that's where it ended today. So tomorrow we will be looking at a zone combination of actually 4. This is zone 4, and it closed right up in there. And whatever zone it opens into tomorrow. So let's say it opens into tomorrow's zone 5. Then a 4-5 combination will have a certain set of probabilities for tomorrow's day that we can look at to determine how the market is likely to behave for that day. Once we did this, and once we chose this approach for intraday charts, the question was, could we do the same thing on a daily basis or on daily charts that we could on intraday? And we went back and checked and ran thousands of runs to see what would happen and determined that indeed that could also be. And I'm going to change over now to a weekly probability chart. So you can see each one of these red lines represents a day, and here's the start of a week, and there's 1, 2, 3, 4, 5, and then we get another set for the next week and another set for the next week. So instead of looking at the intraday probabilities, what we're looking at now is the weekly probabilities. So if you're not a day trader, but you're a stock trader, and particularly interesting, let's say that you're a weekly options trader, and you want to know what the odds are that the price is going to go up to a certain level or below a certain level. These tools are invaluable for weekly options traders because at the beginning of the week, right here, when it opens, it's going to put these probabilities. And it shows me that the odds are 56% that the price will get up into this zone during the week, only 22% that it's going to get up into this zone, 65% that it's going to get down into this zone, and 28% that it's going to get down into this zone. And if we run it on up, only 5% that it would ever get to this zone. So you could do your weekly options strategy accordingly to trade it either to the bull side based on the percentages or to the bear side. Now in this case, the bear side said 65%, which it didn't reach. So these tools are not perfect, but they're certainly very helpful and give you one additional piece of information to make your trading decisions. If we look at last week, which was here, we had actually the same ratio because the open to close was the same. And so you'll see the same numbers here. And again, we had a 56% chance that it was going to go up to here, 65% chance that it was going to go down to here. And in fact, it just barely touched that 65 before going right back up into the 56. And as you know, this has been that was a very strong week last week. And so it went into all kinds of new highs. Here's this week. This was Monday, Tuesday, Wednesday. And Monday and Tuesday basically traded within the normal 100% range. And today, it zipped up into the 46% range, but stopped before it got to the 17% range, and turned around and found the 58% range where it just busted through, stopped, and turned around again. So we'll see what happens tomorrow. This was certainly a very violent move up and down. But the projections would show that the trading range for the rest of the week is still, that this will have defined the trading range for the rest of the week. That there's only a 21% chance that the market is going to go down to 1636 and only a 17% chance that the market will go up to 1693. So that's how we can, for example, look at the market in a bigger time frame. Now, I don't know if we can see any questions or not. But let me take you to the last slide and say that you can get more information about any of these tools at our website, www.janarps.com. You can email us at info@janarps.com and answer any questions that you might have about those tools.